everything you need to know about yield farming. You just barely got a kinda firm grasp on cryptocurrency. Maybe you're considering venturing into buying some crypto yourself. Maybe you've even made an initial investment, and now you're hearing about ways to earn more crypto with your crypto. Someone told you you could earn interest on your existing crypto. Your friends are chatting about NFTs and yield farming, and you feel lost all over again. Fortunately, when it comes to yield farming, as with most things, the song is the same, it's just the words that have changed. Yield farming and its relationship to cryptocurrency is a simple concept to grasp and to work with once you understand some of the finer points. But before we get into that, hit the like button, subscribe, and turn on all notifications to help support our channel. Now, let's jump right in. The banking system. For hundreds of years, people have relied on banks to do two things: make money and lend money. That is the sole purpose of banks. For those who do not know, when you deposit your money into the bank does not keep it in cash in a vault and let it sit there until you want it. When you have money in a bank, especially a savings account, a certificate of deposit account, CD, or a money market account, the bank uses that money. To do what? To lend it out to people who need to borrow money. It could be for a house, for a car, for a small personal loan, or even just a credit card. The bank charges interest to the borrower, and it pays interest to the depositor. It also takes a nice, healthy fee, which is why you usually don't make much interest on your savings account. Where you will make a lot of money in the financial world is in investment funds. You pool your money with other investors in a fund that collects stocks, bonds, securities, or other assets. You make money based on how well that collection performs. With things like mutual funds, you can play it very safe and only invest in accounts that are strong and stable, earning you small but reliable growth over the years of your investment. Yield farming. What does that have to do with cryptocurrency? Well, cryptocurrency is money without a bank. You have this digital currency that is just kind of floating about in tech space. You can buy it, you can sell it, and you can trade it. But how do you grow it? Enter yield farming. Yield farming is just like investment banking described above. Cryptocurrency owners pool their crypto into a digital fund through a decentralized app and earn rewards, interest, and/or more crypto. Yield farming is the most profitable form of decentralized financing, essentially the unregulated and decentralized banking system of the internet. While it stands to make investors a tremendous amount of money, it is also highly risky due to a number of reasons. When yield farmers, also known as liquidity providers, invest or lend money, it is known as staking. The decentralized application, also known as dApp, is like a digital bank or investment firm. These dApps are hoping to grow through these pooled investments. They, just like a bank, take their cut from lenders and borrowers exchanging crypto. When a liquidity partner stakes crypto, the crypto is then locked in for a period of time, and the LP earns interest in the form of APY, or an annual percentage yield, just like at a bank. The APY can be in the double digits, which is a huge return in the finance world. Most investment funds are happy to earn 6% or 7%. Most yield farming takes place via a smart contract, which is a piece of code running on a blockchain, functioning as a liquidity pool, which is accessed through the dApp. Why borrow crypto? So, lending or staking, crypto makes sense, not taking into account the risks, of course, which we'll get into in a minute. But why would someone want to borrow cryptocurrency? To make more money, of course. Borrowers in yield farming enter these dApps, pay usage fees and interest rates to borrow crypto, and then they hope to turn it around by making a profit off of sharp swings they anticipate in the crypto market. If a borrower accurately predicts crypto will rise dramatically soon, they could borrow crypto low and sell it high, making a tidy profit. They could then wait for crypto to drop once more, buy low, keep that aforementioned profit, and pay back the dApp. Risks of yield farming. All of this yield farming sounds wonderful in a perfect regulated world, but crypto is highly imperfect, volatile, and deregulated. You could lose your money at a moment's notice. Rug pulls. Rug pulls account for the vast majority of losses in yield farming. They occur when a developer of a dApp takes funds from lenders and then disappears with the funds, never following through with the APY returns or lending the crypto out to borrowers. Scammers. There are also scammers, of course. An LP, excited to make money on yield farming, could unwittingly stake thousands in crypto on a scam dApp, never even set up to make you money. The scam could occur within the smart contract with faulty code or some other form of digital corruption, allowing the scammer to take off with your funds. Volatility. Crypto is notoriously volatile, with pricing surging and crashing unpredictably. You could stake your funds in the bottom of the market on crypto could drop out, and you would lose everything. Because your coins are locked up, you would not be able to pull them out in time to avoid the crash. Most common dApps. If you do decide to stake your coins on yield farming, be sure you know the most common dApps in circulation right now. The most important thing to do before staking is check your dApp, the history, the creators, and all parties involved. You do not want to lose all your crypto on a scam or a rug pull you could have avoided. Most common yield farming platforms today: Aave, Compound, Uniswap, Sushiswap, or Curve Finance. Remember, while the rewards in the crypto world stand to potentially be great, it is true that if something seems too good to be true, it probably is. If you come across an up-and-coming dApp promising triple-digit APY returns, proceed with extreme caution. In the fast-paced world of cryptocurrency, where everyone is determined to get you to act now and act without thinking, it is best to take it slow, calculate your moves, and learn as much as you can before moving forward. It can feel a little bit like gambling in Vegas at times, but it doesn't have to be. Yield farming can be an incredibly lucrative venture to participate in. You just want to make sure you go in with eyes wide open and remember the age-old advice to never gamble what you can't afford to lose.